Thanks for everybody for coming. I want to talk about a few different things today. Number one, as you can see on the slide, I want to talk about how in order to earn outsized returns, we believe you have to do non-obvious or uncommon things. To us, that just sounds sensible, but it oftentimes is, I think, forgotten. You can't just own the same stuff as everybody else and expect to outperform. You can't own the same things as the index and expect to outperform just, by definition. Also want to talk about, I think, some common misconceptions about the asset class of global smalls that I think are important to communicate. And then lastly, with some examples, we'll go through just this thought experiment that the team has been on for the last while, which is investing in compounders sufficient? Or is there a higher bar for how you should be deploying your time and capital? So the pyramid is, I think, one of the most misunderstood aspects of small cap investing. If you only remember one thing from today, this is probably the most important thing to remember. The average client portfolio would have somewhere between 3 and 5 managers potentially hunting global large cap or global equity. The typical client portfolio, at least as it's felt over the last number of years to us, would have somewhere between 0 and 0 global small cap managers hunting global small cap. And yet the data, the developed market universe of listed companies, has about 75 to 80% in the small cap universe. So large cap is roughly a tenth or 1/10 or 15% of the size of the number of companies in small cap. And so for the very simple reason that you're missing out on 85% of the listed companies globally in the developed world, most portfolios should have at least one manager hunting those 2,500 to 4,000 companies. Doesn't have to be us. There's a number of very capable managers in the asset class, but our concern isn't about returns. It's about diversification. Whether or not we're the performance leader in a portfolio, I think is secondary to just making sure that you're turning over all of the appropriate rocks that exist in the developed world. And so, this pyramid, I think, is just the one chart to take away from today. And the way in which we do it, which is, I guess, somewhat different or unique, is a lot of in-person meetings. And so the analogy we always give is to real estate. If you were going to move your family and you were looking for that forever home and you were going to raise your family there, you're probably not buying that house behind your desk using the computer. If you're buying a property for investment purposes that you never plan to move into and maybe you'll own it for a year, maybe you'll sell it before it's fully constructed, yeah, you can buy that property from behind the desk because it's an investment and it's never going to impact you and your family or your livelihood in the same way as where you're going to raise your family. You're going to worry about the neighborhood. You're going to worry about the school system. You're going to worry about that tree in the backyard. Does it have some sort of issue? How long is it going to be around for? Is it going to impact my view? What's the zoning regulations in the surrounding area? Like 100 different things would probably go through your mind before making that 25-year purchase of a family home. And that's how we think about every investment. So the idea that we're going to make successful investments over really long periods of time from behind the desk is just not something we can comprehend. And so we end up with a chart like this. In a typical year, we'll meet roughly the S&P 500. Last year, it was a little bit less than that, 333 companies. We'll head to wherever we need to, which is typically not the cities that are fun. We end up in a lot of industrial cities, tertiary, secondary cities, outside capitals or nowhere near capitals, or requiring taxis or trains or, rental cars. But it's we think, a critical aspect of turning over as many rocks as we do. And the summation of this slide actually was that we made 6 investments in 2023. So we are very active. We do take a lot of meetings, but we're extremely selective in the things that enter the portfolio. I guess the thing I also didn't touch on, beyond just the sheer number of companies that are being neglected when people aren't hunting small, the second aspect of that is the returns have actually been pretty good. And so I think Marcus had the chart up, but whether or not they outperform large to us is probably the wrong consideration. It's that they, on an absolute basis, have delivered strong returns. Our clients have earned 15% net return over the last 14 years through a whole bunch of headwinds, a whole bunch of tailwinds, a whole bunch of kind of meandering time periods where nothing was going really wrong and also nothing was going that well. Interest rates went up, interest rates went down. And the way in which we've been able to do that is by focusing on pretty much one simple thing. Our fundamental view that stocks follow cash flow. And the best way to capture that are find businesses that are compounding earnings and cash flow every year and are doing it on a self-funded basis. So these would be the 6 things that we think are critical to finding a special company. And I'll later show you how a special company doesn't mean a special investment. It's an important distinction. A lot of people think high returns on capital are good. And we agree that they can be good, but they also attract competition, consternation from customers, oversight from government. And so one of the things we really focus in on are sustainable and improving returns on capital, much more so than the absolute magnitude of the return on capital. And so for fun, some of the things that we've discussed as a team, what's the opposite of a compounder? If everyone in every meeting is saying we look for compounders, we invest in compounders, we think compounders add value, well, what if you weren't looking for a compounder? What would you be looking for? And so the Webster definition was negative growth, so we just used that. And so the next time you guys have a fund manager in your office and they say we focus on compounders, just remind them that's an absolute fact that every person who comes through the door will probably say for all of time, because nobody's investing in negative growth. The second thing that I think is neglected with compounders is it's got to be seen in the context of a hold period. Because if you say you focus on compounders and your turnover is 94%, you're not actually owning it long enough to benefit from compounding. Compounding occurs slowly over time, or even at appropriate rates over time, but it requires a multi-year hold period to actually benefit from the compounding of those earnings and cash flow. And yet we see a lot of portfolios and talk to a lot of managers where they'll be investing in Q1 and selling in Q2. And so then it becomes challenging to think that the most important thing was the rate of compounding. And so one of the things that we're going to probably talk more about over time is just this concept of non-obvious or less obvious compounders. Non-obvious sounds a bit arrogant, so maybe less obvious compounders. And there's some examples here that I want to walk through to just help set the table for what do we mean by non or less obvious compounders. And so by show of hands maybe, how many of you have owned or know of CSW Industrials? It's a U.S. industrial business that was spun out of Capital Southwest in 2016. How about the brands on the bottom left? True Air, Rector Seal, Greco, Balco. Many of you probably have their products in your house. But the thing that's good for us is you actually can't see the brand. The brand sits within your HVAC unit, and you have no idea how much their components cost relative to your system, because when you're buying a unit, you just care about the bill, the total bill. How much is it going to cost to install? How quickly can you install it? And what's it going to cost me? And not what is the bill of materials within the unit. So the chart on the right is CSW's earnings over the last 8 years. So it was spun out in 2016. They did about $1.65, $1.68 in earnings. And this year, we're just over halfway through the year, they'll probably do about $8. And the other interesting aspect of this, as you can see, is through COVID, through input cost inflation, through wage inflation, and outbound freight rates, and then normalization, they never actually had a down year in earnings or free cash flow. So the earnings have compounded for the last 8 years at 23%. The stock until 2022 actually compounded much slower than earnings. So the orange line is the stock price indexed to earnings growth. And you can see when the orange line's below the blue bar, that means the stock grew slower than earnings. And when the amplitude of the orange line is above the blue bar, it's growing faster than earnings. So lucky us, we started Langdon in 2022, and we were able to buy CSW after a period of really strong earnings growth where the stock had not kept up. And so it's been roughly a 250% return for our clients in about 2.5 years. It's a $5 billion company today. They have 0 analysts covering it. No JP Morgan, no Goldman Sachs, no Baird, no William Blair. Yet this has been the historical track record of the business. Management has been the exact same over that same time period, so stable and proven management team as well. And so what's interesting about this company, and we actually found it back in 2019, we were running a screen before attending an industrials trade show in the Northeast US, and we'd come across all these businesses that were basically trying to be the next Danaher. They all had, Danaher has this famous thing called the Danaher Business System, DBS. And then all these other Midwest industrials had a GBS and a CBS and a UBS, and it was like they're all trying to be the next Danaher in whatever end market they were aggressively consolidating. And they all had a lot of debt and good returns on capital, and the stocks had done really well. And then we came across CSW. It had no debt. It had equally strong, if not higher returns, had 20% EBITDA margins. We said we should probably take a meeting with them. And I don't think any of us at the time expected 5 years later for the stock to have performed this well, or for the fact that there would still be no analysts covering it. This business actually just got added to the S&P 600 on Friday. So like this is what you call hidden in plain sight if I've ever come across one. And so the list at the bottom is the checklist for that compounder. You know, it's got good returns on capital, converts those earnings into cash flow, the reinvestment rate is high, sustaining future earnings growth potential, the leverage is very reasonable, and as I said earlier, proven and stable management. So all the conditions of a compounder, but at the time that we made the investment, and even still today, it's significantly less obvious or even non-obvious relative to a lot of other opportunities. So it remains a holding in the portfolio, but because the orange bar, or the orange line has inflected much faster than the earnings growth, it is no longer one of the largest holdings in the fund. So quintessential example of what we think is a less obvious compounder. Don't shoot me with this one. So one of the most widely debated, discussed, loved, hated, and everything in between companies in small cap, mid cap, large cap Australia. It's been all of those things in the 8 years that this chart represents. But what if I just said 8 years ago, in 8 years, the earnings will be flat? Like what if it was that simple? And obviously no one expected that. Don didn't expect that. The investment community didn't expect that. No one expected that. And I want to be very fair. I think this has been an incredible wealth creator for a long period of time. It has all of the attributes, or many of the attributes, of a compounder. And you can see over that time period, you know, over the last 8 years, our earnings in the stock correlated at different points in time, but also have decorrelated or have become less correlated or uncorrelated. So in 2021, it was roughly true that the stock had compounded at the rate of earnings. And then as you can see, since 2021, I think earnings are down 20% and the stock's down 70%. So as an investor, and in number one, believing that pizza businesses should be good businesses pretty much everywhere except for Denmark and Italy, this could be a really interesting time to look at the company. So we don't own it. This is, you know, as much about just trying to present a relevant and well-understood example here. But as you can see, and it's not all gone according to plan. And I think in one chart, this would be the thing that we would probe in more detail. We actually had Don in our office in Toronto on the Friday before I arrived, and we showed him this. And we said, so you've been here for 2 decades. You started at Silvio's as a driver, and we all understand the story. You know, Richard's been here for a long time. How come everybody who reports to you just got here? And a lot of the people that spent 20 years with you aren't here anymore. And so that proven and stable management piece is also critical for long-term earnings compounding. And credit to Don, you know, what he said was, we have seen a lot of turnover within the team. I feel really good today relative to a year and a half ago on where the business is, but we still need some more time. A lot of these regional leads haven't been here for as long as I'd like to feel comfortable. And so I'll feel more confident in the next couple of years if we're able to continue executing with this, you know, newer group of senior leaders. And so one of the things that we do when we travel and meet these companies, we don't just meet CEOs and CFOs. We go meet operating levels of management. We go meet people who actually do the work to help drive the results for shareholders. And so this chart would be one of the ones that I would say has kept us from being more interested, despite the fact that the stock has corrected a lot. And so has pizza been bad everywhere? The answer is no. This is the US Domino's. It's compounded at about 25% for the last 8 years. The stock has compounded at roughly 20% over those 8 years. And as you can see, the stability of management has been a little bit better. And so maybe high levels of executive turnover can invalidate a track record. No different than a fund manager. If you've got a great track record and you've had 9 PMs roll through in the last 15 years, it's really hard to attribute that track record to somebody. And so the last example is AJ Bell. This is like, think of NetWealth or Hub in the UK. It's a platform business. And if you were lucky enough to get a piece of the IPO in 2019, you would have said, I see long runway of earnings growth, really strong free cash flow conversion, no debt, all the attributes of a compounder. Let's invest. And 6 years later, stock's flat, earnings are up 250%. So what happened? And the answer is valuation. You paid 53 times in 2019, and now it's 21 times. And so everything went according to plan, except the valuation going in wasn't aligned with long-term compounding of the stock. And so it's just a reminder that even if you get the earnings right, you also have to make sure that you're paying the right price for those earnings. And so we invest with management teams, and it's important to us that they've proven themselves over a long enough time period, usually a good time period, and also a much more of a challenging time period. And if you can do that, you'll maximize the probability of finding a non-obvious compounder. And nobody wants to end up in the waiting place. You don't want your portfolio in the waiting place. You don't want an investment you've made to be in the waiting place. And so we think non-obvious compounders help you avoid the waiting place. And it's certainly helped our clients in the time we've been here at Langdon, and also going back to our previous firm. We think we've been able to avoid the waiting place as to when will small cap perform. We've said for 3 years we don't think it matters, and we're certainly not waiting for that tailwind, and we haven't needed it to deliver for clients. So thanks, everyone.